So, Kathy, let's go straight into the conversation and cover the Silicon Valley bank collapse, which was obviously a dramatic market-moving event on Friday, and we've seen hugely volatile markets since then. And we'll talk about Credit Suisse and the ECB and the Fed later on. But I really want to get your take on the Silicon Valley collapse, as you've got so much experience in this space. So what were your key takeaways from it?
In my view, Silicon Valley's bank's problems are, to a large extent, very specific to the bank. And I'm not a bank analyst, and I'm not particularly knowledgeable outside of what I've read, but it sounds like they were making loans into assets that might be somewhat illiquid, and that's always problematic. It sounds like they didn't hedge their interest rate exposure, which is a bit unusual for a bank. And so that combination of having sort of this illiquid portfolio that was quickly changing because of the changing economic environment, especially in the tech industry where they're concentrated, and then the rapid move in interest rates, it sounds like it was just kind of the perfect storm for them. I would also say sort of a second takeaway is you have to question, well, where was the regulation that probably should have caught this earlier? My understanding is that it was actually the rating agencies who sort of brought the issue up, and that started the cascade. But we have rolled back some of the regulations that would have probably brought this to light, presumably a bit earlier, and perhaps avoided the rapid decline in the share price. Hard to know, but I think we'll have to take a look at banks' supervision again and see what needs to be changed. I think the third takeaway is just how social media seem to accelerate the pace of decline. Because this is a tech-oriented community anyway that use this bank, it seemed like the social media really accelerated the bank run. And that's something I think we have to think about as well, because it's certainly the world we live in now. We have to think about, well, how do you deal with that? Because you can spread good information, you can spread misinformation, you can spread bad information, and that can cause real life effects. So I think there's kind of those are the three big things that stand out to me.
Yeah, I want to just dive deep into that because I'm very active on social media, and there was loads of people giving their takes, analysts, portfolio managers, amateurs, if you like, everyday people trying to understand what was going on. But it was actually the billionaire hedge fund managers, and we don't need to name any names, and venture capitalists that were almost putting pressure on the policymakers, both on the fiscal side and on the central banking side. So what did you make of that?
Yeah, well, first of all, it's a bad look, right? So these very wealthy people pulling, influence over policymakers, or at least appearing to. I'm not sure what they did or didn't do behind the scenes, but it's not a good look. You want every bank to be treated, and all the depositors to be treated fairly and equally. So it makes it a bad look. And again, I don't know what the real story is. It might have turned out exactly the same thing had it been somebody else. Bank failures are not unusual. They're not uncommon. And we have a regulatory environment. The FDIC deals with it all the time. We merge weaker banks into stronger banks all the time. So the outcome might have actually been the same. But these loud voices, these very prominent voices, bringing it to the surface, it creates this atmosphere of uncertainty but what actually are the rules and what aren't the rules, and do the rules apply to everyone equally?
Yeah, it was very interesting to watch all of these voices. And there was one thing that you said in the opening kind of statement that you just made, and that was really to do with the interest rate hedges. So for our listeners, I think you're the perfect person, obviously, to unpack this as a chief fixed income strategist. How unusual is it for a bank to basically not hedge any of their interest rate risk? And kind of alluding on to the social media point, there's some graphics going around that I'm sure you've seen about big banks, which were kind of saying, okay, they're well capitalized. It's really the regional banks are the focus. But there's lots of graphics going around on social media about these huge hold to maturity fixed income portfolios and the relevant banks' exposure. I'm sure you've seen these. But what it's failing to capture is that interest rate hedge, which most banks have on. So how unusual is it for Silicon Valley Bank not to do that? And what can people looking at the other financial institutions now, what can they make of these graphics going around, and what can they make of the positions that these banks have on?
Yeah, so it is unusual to have that degree of interest rate exposure and not do something to hedge it. In my experience, you would think even smaller regional banks try to manage what you're really trying to do is, do you have enough short-term liquid assets to meet your requirements should something happen? And does that offset what you hold in long-term treasuries and mortgage-backed securities? And it looks as if they didn't get that balance right. You can hedge it with derivatives. You can hedge it just by having the right duration, having enough cash on hand. There's various ways to do it. So hedging often makes it sound more complicated than it is. But it looked like they were just simply not prepared for this run on the bank and be able to generate the liquidity they needed to when they needed to. And I think that that's unusual. I don't think that that's common. When I look at some of these charts going around, it is a little disturbing because people are oversimplifying, I think, the situation. First of all, large banks are subject to stress tests on a regular basis. Smaller banks since 2018 have not been subject to the same sort of regulation and stress tests. And so the large banks are frequently on their own, and certainly for the regulators, looking at, well, what does an interest rate shock mean to my balance sheet? What does it mean to my liquidity position? This is something their risk committees are on all the time. So just because they have losses on paper in a portfolio, doesn't really tell you very much. They could have hedges, which have completely offset that. They could have ample liquidity somewhere else to completely offset that. And they may have stress tested the balance sheet to say, yeah, we can withstand this. And this is actually not a serious issue for us. It really just depends on the bank, the institution. But I would say larger banks, it's a practice, and it should be a practice. And I believe in my experience, it is a regular practice that risk committees look at this all the time. Last thing they want to see is, deposits flow out for some reason and not be able to manage that. And that's a pretty basic risk measure that banks look at all the time.
Yeah, it seemed like a very basic risk management failure. And it was also looking at it, the interest rate hikes of last year leading to a lot of, let's say, VCs, et cetera, pulling back from providing liquidity to companies, keeping, and then pulling their deposit. So it was that asset liability mismatch that you kind of talked about. And I think we can draw from that it was somewhat of a unique case for Silicon Valley Bank, and we can't really draw too many parallels across. With that being said, obviously it sent shockwaves throughout financial markets all over the world. And I think rightly so, given, interest rates have tightened so much from the ECB, the Bank of England, the Federal Reserve, etc. And obviously we're recording today where the ECB have just gone another 50 basis points. And what we saw on Monday was Credit Suisse. And Credit Suisse has its own problems, as we know, lots of scandals, splitting up of the investment banking division to First Boston, etc. So it's not a new thing that they were maybe in a little bit of trouble. However, what we did see yesterday with a 30% plunge in the share price was unusual. And obviously we saw the SNB, the Swiss National Bank, stepping up and providing 50 billion or so in liquidity. So what do you make of that? And what could other vulnerabilities in Europe or around the world, show their ugly heads, given that we've raised interest rates so much?
Yeah, I mean, I think this is one of the things that has underlined our cautious approach to the markets over the last year, particularly the last 6 months, as the pace of tightening by the Federal Reserve has accelerated. When you get these rapid tightening cycles, and we really don't normally, we haven't had one for quite a while that has been this rapid, you catch people in bad positions, right? And I think that there's an old saying, when the Fed tightens, things break. You uncover where the risks are that haven't been properly managed, or where the weaknesses are in the system, where people just didn't anticipate that this rise in rates, this increase in the cost of capital could affect them. So you got a combination of things that typically happen as you get into the mature phase of the tightening cycle, particularly near the peak. What happens is that credit conditions tighten, and that means just the lenders, want more risk premium to lend. The economy starts to look like it's going to slow down. So corporations may have higher borrowing costs. You start to get investors pull back a little bit and be more cautious. And as you go through the cycle, then you find, well, where is the hidden leverage? And particularly leverage that is illiquid. So if we think about private equity and some of these other places that have been hit recently in the U.S., I think a similar story in Europe. This is an institution that's had problems for years and years. So not a surprise. But if there's going to be a loss of confidence, it's going to be in an institution where they've already had problems. And I think when it comes to Credit Suisse, that interview from the Saudis and said, oh, well, we're done providing capital, was really very shocking. And I think that was the catalyst, from what I understand, for kind of this sell-off to go on. The big question gets to be now, we have the Swiss National Bank stepping in. We've had U.S. government, Treasury, FDIC, Fed stepping in to support these institutions. Is this the new norm, or is this just something we're seeing because we're at that point in the cycle where things are really tightening up? I think it's undecided. My view is, though, that this is perhaps going to lead to a whole new level of scrutiny about how we manage these things. And we are going to have ups and downs in the economy. We're going to have the Fed tighten policy and other central banks tighten policy from time to time. We're going to see institutions that don't handle it well. You want to protect the public, but you don't want to bail out people who make bad decisions, right? So how are we going to deal with all this over the long run? I think that's a big question. I would anticipate we'll see some more of this for the time being. This is late stage tightening cycle. This is when things break. You start to see where the weaknesses are. I don't know that they're systemic, that they're going to cause a huge failure in any system so much as just a lot of volatility.
Yeah. It does set a little bit of a dangerous precedent, though, if you're stepping in at the first kind of sign of danger. Arguably, it was probably needed just to stem the tide that could have got, a bit more out of hand. Is there a conflict between price stability and financial stability? You've written about kind of financial instability, tightening credits conditions. Is there a conflict, and what does this mean for asset prices?
I don't know if it's a conflict. I think you need financial stability for the policy tools to work. If you don't have a stable environment, then your policy tools probably aren't going to work, right? So you need financial stability. I think, though, in my mind, what happens when you go into a tightening cycle is that you get tighter credit, and you get heightened volatility, and you start to see economic data slow down. And if you don't have a stable financial system to deal with that, then that's when you get these crises or mini crises. And so I don't know that they're in conflict, but they have to be balanced very carefully. And this cycle, it has been unusual. We've not had a global pandemic before. We've not had the combination of fiscal and monetary policy combined in such a massive way in many years, and then the rapid unwinding of that. I mean, this has been an extremely volatile policy environment. And that being the case, I think that this is where it's just really tough to say, should we tighten more, or is the market tightening already for us? And should we risk heightened financial instability, or should we sit back and hope that that stability comes back and then policy tools can do their work over the long run? I tend to think that it's time for the Fed to pause. I don't think they're going to listen to me. It sounds like they're probably going to go a little bit more. But I think it wouldn't hurt at this stage of the cycle to just pause a moment and say, okay, where are we? What's going on in the real economy? Do we need to keep hiking rates, or should we assess the lags and see where we are, and how fragile is the system?
Right. So you've got the Fed on pause, and it was I kind of spoke about this yesterday about the ECB going arguably. I know they telegraphed the 50 basis point move, and they had to do it basically. Otherwise, there would have been a pretty big kind of crisis of confidence if they didn't. But wouldn't it have been more sensible to just go, okay, maybe we do 25, or we just pause, wait till the next meeting, and then assess? But they went ahead with the 50, so I think we won't know whether that was the right or the wrong thing to do until a few months' time, when we have the 350 basis points of hikes now feeding through into the economy.
Yeah, I would say it's a tough position that the central banks are in, but this is what they're supposed to do. They're supposed to manage risk.
Right, and because of all this volatility that we've seen with central banks as well, there's been a huge amount of volatility in the fixed income markets. And I know you are probably the best person to talk about that. So what do you make of, let's say, the yield curve inversion that obviously was negative 100 basis points and is now at negative 50 or 60, which is a huge move. We've seen 2-year yields both in the US and Germany, really volatile. What do you make of all this fixed income volatility? I think I saw that the MOVE index is now at global financial crisis levels, which is obviously significant. So what do you make of it all?
Yeah, I think what it demonstrates is that we're at that stage of the cycle. You don't get this kind of volatility in kind of a normal, what do I call a normal cycle? Whatever that is, but in a tightening cycle, you don't want to see this huge volatility. And it reflects a couple of things. It reflects the uncertainty about the path of policy. So to go from an inversion of over 100 basis points to 50 or less in a very short period of time is not a good signal. The deep inversion of the yield curve said, okay, the Fed is tightening, and we know it. This what's happening. That means that future inflation and growth should come down, and so longer-term yields are falling relative to short-term. The degree of inversion to start with was extreme, and so that would signal there's a lot of tightening in the system already. But then when you unwind it, it's usually not a good signal, because that usually happens when you go into a recession. And I think the MOVE index right now, and the indexes that reflect the volatility in the market, reflect a couple of things. One, a lot of uncertainty about the path of policy. Is the terminal rate 6% or is it 4%? We don't know, right? And the signals we're getting are all over the place. Is the system financially stable enough to handle this? Where's the economy going? Where's inflation going? I think that if you're investing, just having that level of uncertainty is going to make you pull back a bit. It widens the spread, the bid-ask spread, because people want an extra risk premium to make a decision and make an investment. And that uncertainty level, volatility, that rate of change feeds on itself. And then people are subject to making quick decisions and undoing those decisions very quickly. So we have kind of a perfect storm of volatility. Unlike the financial crisis, though, I don't think this is driven by, again, systemic issues so much as it's almost a reflection of the Fed and other central banks having moved so fast and with so little clarity about where we're headed, that on its is feeding that volatility, and that's not going to settle down until we have a better kind of forecast for the future, where the market feels like it knows where not only policy is going, but where the economy is going, where inflation's going. What What is the terminal rate? What is the run rate of the economy? I mean, we have all these questions and we don't have a lot of clarity.
Yeah, and with that lack of clarity, I'm going to try and ask you what you kind of your outlook is for the rest of this year. And I appreciate it can be extremely difficult given just the last few days of throwing everything. Like you mentioned, the terminal rate was heading towards 6% maybe a week ago. Now it's 4, right? So it's incredibly hard, and that obviously impacts your decision as an allocator for capital. So what do you see kind of for markets and economy? What do you think are the most important things for the market and the economy for the rest of this year and beyond, given that we potentially, given you just said about the yield curve inversion, we could be pretty much a recession imminent at this point, but we know that markets are forward looking, right? And that's what they kind of did at the start of the year, even though we kind of knew a recession was coming. They looked through that and started to rally. I'm talking about the growth stocks and things like that. So what's your kind of, what do you make of all this, and what do you think about the rest of the year going forward?
It seems to me we haven't really changed our outlook so much as that we have brought down kind of the high end of the estimate for Fed tightening. We were never at that high level. I think we were probably always a little bit south of the consensus, but I think that maybe one more 25 basis point rate hike, and then I think we're done. Again, those long lags are starting to show up in the data, whether you want to look at money supply, whether you want to look at the credit tightening signals that we're getting in the survey of bank loan officers, it's just showing credit getting tighter. All of the signals in the manufacturing sector have been almost uniformly soft. So now it's a service sector. As we go forward, we're seeing some of that loosen up as well, that inflation at the service sector level. And I think that that's what we'll see going forward as well. It's hard for me to believe that we could have a rapid global tightening cycle and not get a softer economy and lower inflation. Every time you get a recession, inflation comes down. And every time you tighten a lot, pretty much you get some sort of a recession. So I think that the timing of it is very difficult to call, and the depth of it and the duration of it is very difficult to call. But some sort of broad-based decline in economic activity, nominal and real, is likely to happen over the next 6 to 12 months. And I think that that will continue to pull down the inflation indicators, and we'll have now be left with a very different environment than we've been in for a long time. We'll have positive real interest rates. They'll probably be lower, but still positive. And we'll have an economy that has tested sort of the limits of its growth rate, and we'll know a little bit more, I think, looking backwards as to what that run rate is. And that might actually set us up well for policy decisions going forward. But I think that when I look over 6 to 12 months, slower economic growth, lower inflation, risk of recession, bond yields continue to ebb. I mean, they've fallen hugely already, but continue to ebb from here. And eventually the Fed will start to cut rates.
Yeah, so this brings us on to maybe conclude the podcast and the $1 million question, or maybe $1 trillion question, depending on where you look at it from. What should investors do now? So most of our audience are retail investors, really looking to secure their futures and keep growing their wealth over time. And I know you've written about this in your latest piece. So what would be your advice about what people should do now, given we see so much headline risk, lots of volatility? I'm sure you're the perfect person to kind of calm some nerves, let's say.
Well, I at Schwab, our mantra usually is, don't overthink it, right? And we always suggest people have some sort of a financial plan in place. This, though, has been a good test case for people. Like, how much volatility can I handle? We always ask people what their risk tolerance is. People sort of say, oh, I'm kind of moderately aggressive. They don't really know what that means, until it happens to you, right? And then there's your kind of risk capacity. Well, how much of a downdraft in your portfolio can you tolerate and still live the life you want to live and achieve whatever economic goals, financial goals you have. So I think the first thing to do is kind of sit down and say, well, where am I today? And how does that match up with those two questions, my risk tolerance and my risk capacity? And then look to balance the two. But it's always a balance. We've had a lot of people sitting in very short, didn't want to own bonds because yields were too low. Now they're afraid to buy bonds because yields have gone up. You have to balance, right, the riskier assets with the less risky assets, figure out what that combination is for you. That can help you get where you need to go. And then kind of set it and forget it. Try not to overthink or overreact to things, because that's usually when we make mistakes. In the bond market, one of the things that we typically suggest for a lot of our clients is a bond ladder, where they have a portfolio of individual bonds. They spread out the maturities evenly over time, reinvest when one bond matures. What happens is it keeps your average duration kind of in the middle of that distribution, so you don't get as much volatility. It allows you to reinvest to generate more income. And we find if you own the individual bonds, particularly, people are less, from a behavioral finance point of view, less likely to kind of try to trade in and out, because they know that they'll get their principal and their interest payments, and it kind of helps them sleep well at night. So those are really basic financial planning questions. But I think that if you haven't taken advantage of the rise in rates to lock in some of that income, we've been suggesting doing that, because for a lot of people, they've been sitting on the sidelines waiting to get that income, and there's still an opportunity to lock that in for several years into the future.
Yeah, there's income and fixed income again.
There
was one bit I just wanted to touch on before we kind of end this, that you kind of mentioned about staying up in quality in that kind of ladder. So is that what you're kind of advising at the moment? Stay up in quality, maybe avoid junk bonds and anything more tied to, let's say, a credit event?
Yeah, absolutely, especially at this stage of the cycle. Because this is when you start to see those cracks in the system, right? And just as we saw with the bank, this is not when you want to be in the credit risk area in a heavy way. You might have some small allocation, but I wouldn't overdo it, because eventually in every cycle you start to uncover where the weaknesses are, and usually the lower credit quality, say corporate issuers, have less liquidity, much more debt. Their earning power may or may not be strong enough to withstand a downturn in the economy. They have to refinance at higher rates more frequently than a large company usually does. So we'd be, and also very correlated with equities. So you might be actually increasing your equity market risk by owning high yield bonds. So we think there'll be a time when you get compensated with enough yield that'll be an attractive proposition. But right now, the extra yield you get in going down in credit quality doesn't really reward you, particularly in an environment where we could be going into a slowdown.
Yeah, that was absolutely brilliant, Kathy. So I think that's a great way to end this this talk. So thank you so much for giving up some of your valuable time at a time like this. I'm sure all of the listeners will really enjoy listening to this.
Well, thank you for having me. Really appreciate it.